Hi everyone, my name is Joseph Alchakia and this is Business in 10. Today I will be talking with Adrian Brown from IG Wealth Management about money and life planning. Adrian?
My name is Adrian Brown. I'm a certified financial planner with IG Wealth Management. Been doing this for about 9 years.
Fantastic. So what we're going to do today, Adrian, thank you for being here. We're going to talk about money and life planning. I guess most of us should be worrying about this, but when we're
Absolutely.
young, we don't worry about it. We worry about it when we get a little older. So I'm thinking that let's focus on the 50 plus folks, because I think when you hit 50, you worry about these things a little bit more. What's your
Yep.
experience? Is that really what you?
Very much the case. Young people are more focused on the here and now. And as you get into that, what I'll call a pre-retirement age, people are focusing more on what is coming down the road.
Right. So 50 plus really is where people start really thinking about, whoops, did I do it right? Do I have enough money?
Do I
And
have enough money? Exactly.
yeah, so is this somebody would say, because us Canadians, I think we're shy talking about money, and we think, money doesn't buy you happiness. But I say, if you don't have money, life is pretty miserable.
Yeah.
you know,
You need a certain amount of money to be happy. Maybe
yeah.
a lot. It doesn't necessarily increase your level of happiness, but you need a certain minimum amount for sure.
Yeah, I mean, you're miserable otherwise. If you want to do something and you cannot do it and you need money, life is pretty tough, especially when you get a little older, right?
Yep.
All right. So let's think about this for a minute and let's see now from your perspective, when people come and talk to you, what are the very few questions you ask? Like, you're 50 plus, and then what?
Yeah, I mean, it comes down to the fundamental process that I work people through is, well, where are you at now with respect to income, assets, debts? What's your situation right now? And then the second big part of the conversation is, well, where do you want to be? And from a retirement perspective, that would be, well, when do you want to retire? What sort of lifestyle do you see yourself living in retirement? Could you put a number on that? Would you travel extensively or not?
Hmm.
All relative to today's world. How long are you going to live? What's your life expectancy? How much money do we have to set aside to fund your retirement lifestyle? And then we do some planning work to see where that pans out in terms of whether you'll have enough money based on those assumptions.
Perfect. Let me throw a couple of statistics at ourselves here. So according to Statistics Canada, we're living to the age 85 and maybe longer. So that's a long time, right? And hopefully longer, right? So
Yep.
people, when they think about retiring, they think 60 to 65. This is the kind of time frame they want to retire. And then if you think about this, you will be in retirement for 20 to 25 years and hopefully longer. So that's a
Yep.
long time to finance, right? If you're not,
It
if you don't
is.
have any income. So, and also, like you mentioned, you have lifestyle. So you got to talk about lifestyle. Like, think of today, what you have, and then how do you want to what kind of lifestyle you're going to have when you are in 60, 65 and older. So that kind of makes a lot of sense. So this is a big deal in terms of planning. This is not for the faint of heart if you don't think about it early enough.
Yeah, absolutely. And there's the fun stuff to think about: traveling, golf, hobbies.
Right.
You have to think about perhaps things that are not so much fun, like healthcare aspects. What will be some potential healthcare costs down the road that you'll have to account for in retirement, especially or generally speaking, later in retirement?
Right on. So this is a big deal, and I know what I did when I was younger. I did not worry too much about retirement. I'm an entrepreneur, and I felt, the world is mine, and I'll figure it out when I get there. Wrong. Don't do that to yourself. So, but then, if you think about it, and I remember a while ago, people would tell me invest in a stuff that you know. So I am in the high tech business. And in the early 2000s, I was investing with what I know. And then the high tech business went to heck. And guess what? I lost a lot of money. So it's really, and I say, and I know I'm a little bit like a kind of savvy, a little to a certain extent. I say, don't do it yourself. Like, if you do it yourself, you're gonna screw it up. And I really did. I really, honestly did. So I wish I had lesser of an ego, first of all, and let somebody else worry about it for me. What do you think?
Well, I'm an ex-Nortel guy, so I call myself a Nortel refugee. And
Good one.
in terms of, and I hope that's not an offensive term to anybody, in terms of making light of the real refugee experience, but I had a lot of money invested in Nortel shares and stock options. I had my salary invested in Nortel, and that's the industry I knew. And I was, in retrospect and in any respect, heavily concentrated in a single industry and a single company, and that did not work out well for me.
Yeah.
To my salary, pension plan, investments, otherwise. So, yeah, I mean, doing it yourself, if you have the time, aptitude, interest, skill, whatever, is a possible way to go. But there are people out there that do this for a living every day. And why would I forgo their expertise when I could free up my time to do lots of other fun stuff?
All right. I agree. So I agree. So, if somebody, like people think that they're going to outsmart the market, they're brilliant, and somehow there's this magic and people come up with statistics and all these equations. You know what, it's really a tough deal. Not too many people can outsmart the market. You really have to have a sound investment strategy.
Yeah, for sure, and it's got to be consistent. The old adage I always adhere to is, if you want to try to time the markets, you have to be right twice: when to get out and when to get back in. And yeah, you could get lucky from time to time, but
we screwed up really good. I mean, fantastic. Financiers that they also admit, like, this is a tough thing to manage, because who would have predicted, for example, COVID? Nobody. And the market goes down. Lucky it has gone up again, which is great. But really, who could predict these things? Nobody can. Doesn't matter how brilliant you are.
Yeah, and in the middle of it, you didn't know how bad it was going to be. And I was talking to a number of clients last February, March of 2020, and yeah, the markets were dropping, people's investments were dropping, and in the middle of it, you just don't know how far it's going to go. So yeah, it's scary, and I totally understand that, but it comes back to the short-term view of things versus the long-term. You could argue that in the longer term, things were going to get fixed, and we're still in the process of things getting better, but the markets have recovered nicely in the intervening months since then.
So let's talk about this for a minute. I did some calculation, and I figured, since the S&P 500's inception, which is about almost 100 years ago, and let's take the Great Depression out of the equation. Okay, just look at other things since then. The S&P 500 did go down, of course, depending on what happened in history. But then it went back up. So let's say you have $100 and there's an event. It took the S&P 500 down, but it's recovered on average most of the time, even the worst events, within 3 years. So that's not bad. Actually, if you think about it, if the S&P 500, which is the best 500 companies trading in the United States, so the market actually more or less recovered within 3 years. If you have $100 3 years ago, the market went down. 3 years later, you have $100. That's not bad. And then you continue from there. And then if you look at the average of the S&P 500 since inception, it's like 10% year over year. That's huge.
Yep.
Cumulatively, right? And so people kind of worry about these things, and where do I put my money, and things like this. And it seems to me, when you hit the age of retirement, people have this rule of thumb, and just to keep or make things simple for their clients, and they go with the rule of thumb. One of them, anyways, is 100 minus your age. You put that in equity, and the remainder in safe investment. So if you're 60, that means 40% in equity and the rest in safe investment. Well, that doesn't work anymore if you're going to live to be 85.
Yep.
So what do you do?
And it comes back to what you define as safe investments, using that terminology, because with a long time horizon for retirement. You already mentioned people are retiring between 60 and 65 on average, and they're living till age 85 or 90 on average. That's a very long window to fund, as you've already pointed out. The risk of being too conservative in your investments is that the inflationary effects on your money are insidious, in that inflation at even 2 or 3% per year can erode your purchasing power. And just as a quick example, if inflation is running at 3% per year for 24 years, the old rule of 72, some of you may have heard of, that will cut your purchasing power in half. So $1,000 today would only buy $500 worth of the same goods and services in 24 years, running at 3% inflation. So have your money working reasonably hard from an equity point of view, participating in the growth of companies around the world, to have a chance of staying ahead of inflation.
Right. So also what kind of intrigues me is these quick things to kind of calculate things for clients, because really, as soon as you put a chart in front of a client, I'm one of them. My mind goes,
eyes glaze over.
I don't, and I'm an engineer and I'm good at math and all that stuff. Even then, as soon as you see a chart and all the statistics, I just, okay, you lost me. So people come up with these simple things. But really, at the end of the day, it's not about simplicity, although it would be nice. So if you're hitting the age of retirement, 65, say, and now you have this much money and you start looking at rule of thumb and things like this. And now some of the investment gurus, they figured, you know what, people are going to live longer. And so let's not really screw this up for them. And let's look at another way of doing investments. And they start coming up with 110 minus age, 120 minus age, and so on. And so a couple of these that I've pulled out is like Vanguard Target Retirement 2035. This is targeted people at age 50. And they put 75% of their fund in equity. Okay, that's huge, right? Another one, really, which is even more aggressive, is Row Price Retirement 2035, similar to that, and they're putting 80% in equity. Yep. So that kind of tells you, look, our clients are going to live longer. Let's not really screw them up by having their money kind of not being available to them. They have no money, but because they're living longer, and so they kind of going more aggressive with that rule of thumb.
Sure, and I certainly agree with that approach in general. And you can help mitigate that more aggressive approach by maybe even carving off 2 to 3 years worth of income and putting it into a near cash type investment, such that if back to your example of all the events in history that caused the S&P 500 to drop and eventually recovered on average within 3 years, you could have a pool of money set aside that you could draw from in one of those down periods, while the rest of your portfolio is working on a more heavily equity weighted basis, and have that bigger pool of money still have that chance to outstrip inflation in terms of overall growth.
I like that. That's what I'm going to do. Really, because it's really, so what you really said indirectly is about cash consumption, isn't it? It's not about a percentage of portfolio, because if somebody has $100,000, let's say at age 65, only 100,000, okay, and then he's going to spend 100,000. Well, you know what? You better have 100,000 in cash, because you don't know what's going to happen tomorrow.
Yeah, but you don't want to be investing in the stock market.
Right, but if you have $10 million, okay, and if you have, and you're spending 100,000 on an annual basis, just you have a good life and you want to maintain it, there's no point of putting 60% or 6 million in some cash investments. This is not good at all. So it's really about cash consumption, like how much you're going to consume on an annual basis, okay, protect it, let's say for 3 years, and then leave the rest working hard for you in the market, right?
Yeah, that's exactly what I'm saying. And
fantastic.
Thought, well, what's the alternative? The fixed income investments versus equity. The interest rates are pretty low on the fixed income side. So is that a reasonably safe option back to how we define safety. I mean, if it's not staying ahead of inflation, there's a danger there. It's not totally safe either. So yeah,
That's right. So also in Canada, I mean, we have the feds kind of helping us out when we get older. So they take money from us in Canada pension plan, and they give it back to us, full at age 65. You can take it earlier, of course, at age 60 with a reduction, and later at age 70 with an increase. Nonetheless, HSD was 65. So, on average, you kind of get, let me check here. On average, we get about $700 in CPP, unless, of course, it's a maximum. And you also have old age security, and old age security kind of helps you in a different way. And it also starts at age 65 with an increase possibly at age 70, if that's what you want to do. Okay. So these things play a certain effect, and it helps. I mean, if you combine them, they're about, maybe $15,000, depending where you are, maximum, minimum, etc.
Yeah.
So how does that play with the? Yeah. Sorry. Go ahead. How does that play in the equation if somebody's?
That's per person. So a married couple would have a very nice base of retirement income when you combine what I'll call the social benefits through Canada Pension and Old Age Security. So it does provide a nice base, but depending on the lifestyle that you choose to have, you might want to have a nicer lifestyle. So that's where your work pensions come in. Maybe you're lucky enough to have a defined benefit pension plan at work, or maybe you have a defined contribution pension plan at work, or you're separately in saving in registered retirement savings plans and tax-free savings accounts with a trusted financial advisor. So you have to look at all your various potential sources of income in retirement, CPP, old age security, personal savings, work pension plans, etc., to make sure that you'll have enough when you aggregate all those together, and then work with an advisor to make sure that you have a plan to draw them out in retirement in the most tax efficient manner possible, and ultimately to ensure that your money outlives you. That's the ultimate goal.
So is there a magic number to say, how much do you need to retire? I mean, of course, it depends on lifestyle. Is there like saying, okay, if you make, let's say $70,000 just the day before you retire, 70,000 annually, just the day before you retire, is there a magic equation to calculate how much you need in retirement?
I wouldn't say so. It comes down to a conversation with a single person or a couple to understand what their current lifestyle is in the years leading up to retirement, because some people will carry a mortgage into retirement. Not necessarily the best idea. Some people will have paid off their mortgage years before retirement. So you can't just use a rule of thumb like 70% of your pre-retirement income. It really depends on situation, proposed lifestyle in retirement. Will your kids live nearby, or will you be traveling extensively to visit the kids and grandkids? Will you want to vacation a lot, or will you have expensive hobbies like golf, that sort of thing? So it's really a conversation based on comparisons to the current lifestyle, to see what that future lifestyle would be like.
So, somebody threw at me 70% or something like that.
Yeah, heard that one.
And so I really don't know what it means. I can crunch some numbers. And if I wanted to keep my lifestyle, when I did crunch some numbers, if you make $70,000, say, on an annual basis, and you want to live within a similar lifestyle, of course, when you retire, you don't have the same expenses, but you may add some other expenses.
Sure, exactly. Yeah.
So,
and will you have one car versus two? Maybe your clothing budget will be less or more depending on lifestyle again. So yeah, it comes down to trying to pin down a few assumptions about that future lifestyle, and quite honestly, estimating it to see where we.
So it's an estimate. So you folks would sit down with people like this and we take them through the process.
Yeah, exactly.
All right.
Get them to imagine their future retirement lifestyle.
Switching gears a little bit on you, we talk about life planning. Life planning is just not just about money. It's also about estate planning, right? So again, I'm going to use myself as an example. When I was young, I didn't care about having a will just because you don't think of death. And people freak out about that. They kind of think they're tempting fate if they're writing a will and something like that, which is of course not true. So
Yep.
estate planning is very important, especially, you don't want to leave a mess behind. If you have young kids and if you have older kids, it doesn't matter. It's just, you don't want to leave that mess. So having a
Yep.
will is really important. This is one thing. And, having executors and guardians and stuff like that within the will, which is really important. And today I heard about, not a friend, acquaintance. He had a brain aneurysm. So now he's 63. He's incapacitated, and his family is basically freaking out. Like,
Yeah.
well, what do we do now, right? And now they're worrying about his commitments, because he's a young fellow. I mean, 63 is not young. He's not old. He has practice. He has things to do and things like this. So a couple of things came to my attention, which is like a financial power of attorney where someone takes care of finances, even when you're living, and a power of attorney of personal care, where, if you are not able to make your own decisions, like a brain aneurysm is pretty tough deal.
Yeah, pretty debilitating.
So, I mean, I'm all in for this, given this example. What do you think?
Absolutely. You brought up wills first. And in the case of your friend or acquaintance that had an aneurysm, the will doesn't come into play because, to be blunt, he's not dead yet. And that's where powers of attorney come in. And in Ontario, we have two of them, one for personal care, as you noted, and the other one is called a power of attorney for property. So by definition, one is to allow someone else to make personal care, medical decisions and other personal care decisions for you because you're unable to. And the other one, the power of attorney for property, is all about making financial decisions on your behalf because, again, in this situation, your acquaintance is unable to. So managing bank accounts, paying off loans, getting withdrawals from RSPs and RIFs, those sorts of things, which may be necessary to help pay for some of the expenses that are coming out of this acquaintance's illness in this example. So you need both in place. And typically you would set those up when you're drawing your will up with a qualified lawyer. They would all of those aspects.
Are they ever important, Adrian? This is so important, man. And you don't know until it happens. So it doesn't matter how old you are. These things happen to anybody. You can get into a car accident. Anything can happen, right?
Sure. I mean, the odds of an aneurysm happening to a young person are lower. Let's be clear on that, but certainly far from non-zero in any case. So, but to your point, a car accident and any sort of accident can happen that can debilitate somebody to the degree that they cannot make life care or health care and financial decisions for themselves.
And on that note, because of, some of us, if they're fortunate enough to have stocks and things like this, and if they have a cottage and, recreation properties, other than your home, because your home, if you will it, it's not taxable per se, but the other properties are taxable, and there's substantial tax on these things, because when somebody passes away, most people perhaps don't know, maybe they do know, that when someone passes away, the government of Canada basically says everything is due on that day, meaning as if you sold everything that day. And if you sell your cottage that day, which you don't, but they calculate it as if it was sold that day, all your stocks, bonds, all of those are sold that particular day. And now you end up with a hefty tax bill, right? So what I heard from experts, and I need your input on this one, well, to avoid all of this, you should buy insurance, life insurance of sorts. How do you manage that with your clients?
Well, it does come back to not just writing things down in a will, because the will is really just a simple statement of how you want things to evolve when you pass. I would say an estate plan is more of a proactive planning discussion on how you want things to play out when you die. Some of the things you talked about in terms of assets having a deemed disposition, locking in values, tax obligations, that sort of thing, they do happen to single individuals, but in the case of couples, joint ownership, there are some measures to transfer ownership of those things to the other spouse while the other spouse is still alive. Now, what you're talking about is ultimately when the last of a spousal couple passes, there could be a big tax bill, and people don't realize it. The family cottage, there could be a capital gain on that family cottage. Any RSPs or RIFs or non-registered investments, again, as you pointed out, they would be deemed to be sold on the day, and they're all included in income on the estate of the deceased. So yeah, you're absolutely right. There could be a big tax bill. And how do you want that tax bill paid? Do the kids still want to keep the family cottage in your example? Or would they have to sell the cottage to pay the tax bill that CRA is looking to collect on? Life insurance is a way of making sure that there is enough liquidity or cash in the estate to make sure that the bills can be settled up appropriately, and you have the flexibility to keep the family cottage and distribute other assets as you intended to a favorite nephew or a favorite charity, or to keep the family cottage, as the case may be.
Yeah, I mean, the last thing you want, when someone important like your dad or your mom dies is my gosh, there's so much to worry about.
Yeah.
And now you're forced into selling things, maybe the wrong timing. It's the wrong time to do that.
Yep.
So you don't want to do that. So people think of insurance, I'm going to buy insurance because I have kids, I got to take care of them. But it's really bigger thought than that. It's like, it's way more than just taking care of your kids. It's not about making somebody wealthy per se. It's taking care of affairs. That's why you should have insurance.
Sure, and it's a planned way to look after the next generation in many ways. Certainly there's the protection aspect, and that's key when you have a big mortgage and you have two small kids at home, that sort of thing. But insurance, particularly permanent life insurance, can play a very important role as it relates to an orderly disposition of assets to the next generation, to the wishes that you intended.
So, all right, this is great, Adrian. Thank you very much for being here. So I just want to conclude with something like this. So somebody comes to your office, age 50 something. And so the stuff we talked about today, so is that the kind of a full thing? I mean, of course, it's more extensive than this because you got to get into the details. So is that what the kind of stuff you would want to talk to them about, to kind of walk them through not just the money side, also the estate planning side?
Absolutely, yeah. I mean, many people think they have a financial advisor and they have an investment advisor. We take a broader approach and build a comprehensive financial plan that looks at all the aspects of retirement income planning, estate planning, tax planning, and any other things that you want to develop goals around and plan for in the long term. So we really espouse that comprehensive, long-term, relationship-based approach when it comes to financial planning.
Fantastic. Well, thanks again for your time. Really appreciate it.
Great to be here.
I hope you enjoyed this interview with Adrian. There's a lot of stuff in there. Thank you for watching, and see you next time.